Gas prices. We're at $5 a gallon, national average. California, they may be at 10 already. At least they're trending that way. What is going on with gasoline prices, and how do you kind of evaluate how high they could actually go?
Well, they're going to go. This is traditional of energy crises, and we're very much in an energy crisis. If you look at how we define it at 42 Macro, whenever you have a trailing two-year change of trailing two-year doubling or more of the crude oil price or natural gas prices or gasoline prices, which we're very clearly observing that in across all three of those markets, we tend to see that as an energy crisis. The history of energy crisis is actually not very kind when you think about it from an economic perspective or how they end, because they typically end because these are very inelastic goods. We typically, we'll need them no matter what the high price is until you really start to cut off the tails of consumption. These things typically end when we start to sort of price people out of the market, unfortunately. So we're talking about low-income families, middle-income families, just not being able to fill up the tanks.
So there's been a lot of talk of price gouging. And then also there is talk of the equivalent of shrinkflation. There was a little controversy on the show earlier today. They're increasing the amount of ethanol in the gasoline. How do you think about the dilution of the gasoline, like the quality people are actually getting? And then how do you think about evaluating, are these gas stations or gasoline providers price gouging versus they're just responding to market dynamics?
No, they're definitely responding to market dynamics. And if you look at a chart of crude oil prices, outside of the grade that Russia ships, I think it's called euros or whatever. Don't quote me on that. But anyway, the Brent prices are, rocketing to the moon. WTI prices, which is what we produce here in the United States, rocketing to the moon. And oh, by the way, just for folks who don't know, there's all these different grades of gas, of petroleum, of crude oil. And one of the reasons, the U.S. is I think either the first or the largest, first or second largest producer of energy in the world, but yet we're also still, I think, the first or second largest importer of energy in the world. And that's really just a function of, our grade that we produce is very light. It's very sweet. I don't know who the hell's drinking crude oil to figure that out, but it's very light. It's very sweet. And we need to mix it with the much heavier sour grades of crude oil in order to put it in your car, fill up your gas tank for the engines to effectively work on an optimized basis.
So when you start to think about gas prices, I immediately jump to the fact that certain portion of people who have long commutes, who usually are lower income, gas makes up a much, much higher percentage of their monthly expenses than, some rich billionaire who it's, nominal amount of what they spend on a month-to-month basis. Is that a perfect example of like everyone experiences inflation differently?
100%. Everyone experiences inflation differently. They experience financial tightening differently. And so when we talk about things like, inflation pricing out or slowing consumer demand, it doesn't just hit like all in 1 month or is this one monolith. It's a process whereby incrementally, as prices continue to rise, we price more families out from incremental consumption, because again, it takes up a greater share of wallet. So discretionary purchases and even some non-discretionary purchases start to get curtailed at the margins. We're certainly already observing that in the consumer spending data. When you look at real PCE growth, it's somewhere we're tracking it around only 1.8% on a 3-month annualized basis. That's below trend. That's below our sort of potential growth rate that we've observed in the economy in the past kind of 5 or 6 years. You look at it on a goods, goods consumption is basically zero. We're no longer growing from the perspective of consuming goods because, again, energy prices, food prices, et cetera, are really pricing out discretionary purchases. And then even services consumption, with a one handle on it at 1.8% 3-month annualized. That's telling you that very clearly the broader sectors of the economy, which is the consumer, is really starting to slow down and feel the impact of this stuff. And so to answer your question, yes, it impacts different families and different segments of the income cohort differently, but it's not just energy prices rising. Don't forget, we have this entity called the Federal Reserve that's hiking interest rates and draining liquidity from financial markets through quantitative tightening and through its reverse repo facility. And that financial tightening that we're observing in the equity market, rising equity risk premiums, in the credit market, rising credit spreads, that doesn't hit companies all at the same time either. You're going to have bad companies or companies with very risky operating budgets or high fixed costs get hit sooner and harder in other companies, but ultimately it's going to hit us all when you look at it on an aggregated basis.
When you think about this, obviously there's core CPI and there's a CPI metric, and they remove energy and food. Does that change how much weight of importance you put on either one of those metrics when you see gas prices exploding like this?
Yeah, so let's start. The core CPI is just another name for that is convenient CPI for policymakers, right? Let's strip out the stuff that goes up the most whenever we have an inflationary episode, so we can make it pretend like we're actually doing something about inflation, or at least doing it's not as bad as it otherwise would be. But when you're talking about core, whenever you're trying to get financial markets right, you need to predict the things that the central bankers are looking at and will respond to, irrespective of the fact that as a human being who fills up my gas tank and eats food, very clearly are experiencing the inflation and the shrinkflation that we're all kind of pissed off about. And again, this one thing about inflation: when inflation's high, it's the only thing you think about. It's the only thing you talk about. And obviously, we've been talking about inflation for quite some time on this program, and we'll continue to talk about it for some time on the program. But anyway, the point about core inflation, you always want to make sure that you're focused on the things that the central bankers are focused on, so that you can stay 1 to 2 steps ahead of positioning for the liquidity cycle dynamics that are important for financial markets. And with respect to core PCE, which is the Fed's preferred inflation metric, which basically strips out everything that you and I would consume on a consistent basis. I mean, it's a pretty we don't need to get on the index construction, but that is running at about just shy of 5% at about 4.9% year over year. Now, obviously, you look around, that's a ridiculous statistic. House prices are up 20% year over year. Energy prices are up, let's call it 100%. The food prices are up, 50%. That's obviously a ridiculous metric. But again, it's now starting to move in the right direction. So it's telling you that inflation momentum is really waning. But the key takeaway for investors is that the momentum may be waning, but the level is still dangerously high from the Federal Reserve's from the perspective of the Federal Reserve reaction function.
So we've got a chart here. It's the core goods CPI and disinflation. Explain what's going on here and why you think it's so important.
Yeah, so these two charts go together. This first one here is core goods. So tomorrow, for everyone not paying attention, we're going to get the May CPI report coming out of the U.S. economy. And sort of part of the reason I put these charts together is there's sort of a developing consensus in the marketplace that inflation has peaked, it's rolled, and we're just getting closer and closer to the Fed finally, giving up on policy tightening, et cetera, et cetera. We happen to have a very variant perception to that view. We don't think the Fed's anywhere near giving up policy tightening. And in fact, when you look at the inflation dynamics themselves, which we'll talk about here in this chart, it's not so clear that inflation, maybe inflation has peaked on a year-over-year rate of change basis, but it's not so clear that we're going to see a significant disinflation, a deceleration in inflation in the coming months. And the reason I say that is because what if goods disinflation in core CPI in this chart, the top panel just shows the index level of goods prices, core goods prices. So obviously we've had a significant inflation in core goods prices. The middle panel shows the year-over-year percentage change in that top panel, and the bottom panel shows the 3-month annualized percentage change. So we're still, very high on a year-over-year rate of change basis in the middle panel, but we basically ground to zero on a sequential basis. And so it's telling you that disinflation in core goods CPI, which is causing disinflation in core CPI and core PCE, has been the driving factor. But the next chart, which is what if ... is overpowered by accelerating core services prices. And to me, this is kind of the one thing that I don't think the average investor is paying attention to, which is the potentiality for the disinflation in core goods to get overwhelmed by the acceleration in core services. Same analysis. The top chart just shows the index level of core services. The middle panel shows the year-over-year rate of change, and the third panel shows the 3-month annualized rate of change at around 7.5%. We're building momentum to the upside in core services prices, and oh, by the way, services is a much larger segment of the economy. It's about 2/3 of the economy, or 2/3 of consumption. Sorry, 75% of consumption, 2/3 of the overall economy. And so, if we continue to see this type of acceleration in services prices, which we should, based on house price dynamics and shelter price dynamics, it's very likely that inflation stops improving, i.e. disinflating and decelerating in the summer months. And we might actually get a pickup in inflation, which will cause the Fed to get incrementally more hawkish and markets to go down as a function of that.